Welcome everyone to another Risk Minds webinar, delivering expert insight on risk management. Today, we welcome Alan Langworthy, Executive Director, Multi-Asset Research, and Dennis Tarpey, Director of Regulatory Reporting at Axioma, as they discuss how the investment industry is preparing for Form N-Port, specifically liquidity risk management aspects. We will be live tweeting this webinar, so you can join the conversation using the hashtag RiskMindsLive. And if you have any questions during the presentation, you can send them using the Ask a Question box on your screen. Now, over to Dennis.
Hi, this is Dennis Tarpey. Thank you and welcome to the Axioma Liquidity Risk webinar. Today we're going to be focusing on how the investment industry is preparing for Form N-Port. Our agenda is as follows. We'll first look at the SEC modernization and N-Port overview, followed by Liquidity Rule 22E4, and then challenges of fixed income liquidity scoring, and we'll finish up with some questions and answers. First, the SEC modernization and Form N-Port. Global economic impact. SEC modernization as we know it involves the updated ADV and enhanced registered investment company reporting with Form N-Port and NSEN. Brief history and context of how we got here is in order. This comes on the heels of the Dodd-Frank bill as the regulatory world continues to grow in the wake of the 2007-08 financial crisis. We're all familiar with the financial crisis. Following years of low inflation and stable growth, the global economy began to develop a false sense of market security. Global savings glut, combined with an increased appetite for risk, led to the creation of risky collateralized assets targeting the bubbling real estate market. This bubble was created in part by irresponsible mortgage lending and ratings agencies that were not objective. All the while, the regulatory community was allowing loan-to-value ratios to grow. When the housing bubble burst, most of the banks were left exposed to a flimsy market based upon bad valuations. Credit derivatives, originally designed to mitigate risk, had exacerbated the problem as a few big banks had taken on large unhedged positions. The counterparty exposure led to the eventual Lehman collapse, which caused all market participants to question the viability of their trading partners. The cost benefits of regulation. Increased compliance and regulatory changes have hit financial institutions hard over the last decade. These billions of dollars, however, pale in comparison to the trillions lost in the crisis and the uncertainty of what came next. In reviewing how to avoid this from happening again, Dodd-Frank regulation created, amongst other safeguards, Form PF. Form PF, for private fund regulation, targeted primarily the hedge fund universe in a way to track exposures and systemic counterparty risk. The marketplace recognized the importance of these safeguards, and quarterly reporting to the SEC for the private fund world began. The frightening chain reaction of the financial crisis heightened investors' awareness of the need for tighter scrutiny over our banking system and its intertwined members. Side note, despite the political discussions in the 2016 election cycle, the thought of repealing Form PF is not on the table. It's established and accepted and now leads to the next space, the mutual fund and ETF world. Transparency in all markets. The large banking institutions have poured massive amounts of capital into their existence. Trading platforms and research departments are revenue sources that they're not looking to give away for free. This idea intersects with the regulatory world's idea of market transparency. As a middle ground, government regulation is geared towards internal aggregation and discrete examination of data collected. Viewing whether exposures are too concentrated to regions, sectors, or counterparties, the regulatory bodies can get in front of any potential landmines. The SEC has said they will be using the information collected to, quote, create data mining tools capable of detecting aberrational performance and systemic trends as well as peer analysis. Now, the OTC markets are our main focus as the financial community recognizes the need for OTC markets while also wanting to keep tabs as much as possible. The fixed income arena, notably the high yield markets, work most efficiently in an OTC structure. The limited liquidity requires a greater need for the broker community to source buyers and sellers. Screen trading and automatic trading are simply not viable alternatives in this space. At the same time, as more non-private funds chase higher returns, the SEC is looking to quantify liquidity concerns and increase transparency. So who is affected? This time around, it's the Form N-Port community targeting the RIC community, the Registered Investment Company, for increased regulatory scrutiny. Traditionally, these parties were required to simply record a snapshot quarterly reporting report with Form NQ, with no focus on market stress, counterparty data, or liquidity. Now, once again, with low interest rates, stable financial markets, investors have a more risk-tolerant appetite. The use of derivatives by the mutual fund world has also piqued regulator interest. Many will argue that derivatives can be used primarily as hedges, but potential abuse and counterparty exposure can create problems. Go on to the next slide here. So drivers for enhanced regulatory reporting in this space. First bullet point, structured data format. With Form NQ, the RIC space was required to provide the quarterly data, but not in a structured format. With Form N-Port, the reporting period will now be monthly beginning in June 2018 in an XML format. This XML format will enable the SEC to better analyze the incoming data and observe risk clearer and quicker. XML formatting is currently used by Form PF filers submitting to the SEC, and in the world of data management, this step to XML is vital to observing trends. Systemic counterparty risk. As with the focus of Form PF and the financial crisis in general, the SEC is now looking to closely examine the intertwined risk of common market participants in the mutual fund world. With more use of derivatives and the OTC nature of certain products, counterparty risk is a real threat to stabilization in a downturn. N-Port will require detailed data on counterparties and also highlights a push to strengthen the LEI alignment. Stress and risk testing. Another enhancement of Form NQ is the calculation of portfolio-level sensitivities to credit spread changes, interest rate changes, and price changes in underlying derivative instruments. DV01, DV100, SDV01, CR01, and CS01 will be required across all relevant currencies and maturities. The maturity buckets chosen will be 3 months, 1 year, 5 years, 10 years, and 30 years. Next bullet, the mutual fund and ETF portfolio makeup is changing. As stated, with the chase for higher returns, the mutual fund and ETF space is beginning to take on riskier assets and asset classes in general. The SEC is recognizing this move and the growth of the ETF space and deciding it needs to examine deeper. Chasing benchmarks in this bull market will have this effect. The final point, liquidity issues. So liquidity has always been a concern, but with non-equity products becoming more of a greater focus, the more derivatives, the more OTC fixed income products, the SEC is recognizing this immediate need for liquidity evaluations. With brisk trading of ETFs, a potential false sense of liquidity can exist due to uncertainties and liquidity issues in the actual underlying components. ETFs can be seen as trading much more actively and certainly can be used as a pressure valve, but in a true bear market, how long will these funds be able to manage the downside? Low interest rates, once again, here we have funds chasing high returns in this high yield space, but it comes with the issue of dealing with illiquid instruments. The Third Avenue Focused Credit Bond Fund case in 2015 is a perfect example. In addition, as part of Dodd-Frank, the Volcker Rule puts strict limitations on how a bank's trading desk can approach the market. By taking away a bank's prop trading and with increased capital requirements, the traditional liquidity providers of bank trading desks has somewhat faded, adding to potential increased liquidity strains. For N-Port and Axioma, we'll follow the same workflow used in all of our regulatory offerings. We're using the same engine and model since Form PF in 2012, carried into NFA CPO PQR filings, and Annex 4 for our European-based clients. We examine the adopting release and break it down into data tables. We map the raw data into these data tables and then run through our aggregation coding to produce the answers. We then create the XML and submit. With the data table approach, we recognize this is a data gathering and mapping exercise and are flexible in handling inputs from multiple sources. Brings us to our next part of the agenda, the SEC Liquidity Rule 22E4. Now, portfolio liquidity is beginning with the Liquidity Risk Management Plan, the LRM. So the official liquidity rule is the SEC 22E4. It does have a 6-month lag from the N-Port start. The liquidity mandate will begin in December 2018. Under these guidelines, all RICs must have a written policy regarding the measures taken to ensure orderly, available redemptions at all times, including during sharp downturns. Anticipating withdrawal timings is a key part of this policy. This policy must be approved by the board of the RIC and address protocols around periodically reviewing the portfolio's liquidity and ability to provide cash for redemptions. One major aspect of liquidity must entail ability to liquidate without, quote, significant dilution of the remaining investors' interest in the fund. In other words, price sensitivity must be taken into account. We're not just hitting any bid and saying that's a liquidation. Next bullet, portfolio composition. In drawing up liquidity protocols, a fund must decide, independent of the portfolio managers, how to balance performance-based approaches with ability to liquidate in times of need. As less liquid instruments carry a price discount and high potential payoff, we expect funds to hold as much as they can in this category, and vice versa with the highly liquid investments. In developing these approaches, the fund will take into account each individual investment's liquidity. Which brings us to the classification aspect. The next slide. So, as part of the liquidity rule, each fund has to assign each individual investment into one of 4 liquidity buckets. You see the buckets here, starting on the left-hand side with the first category, highly liquid investment. It's cash and any investment which are expected to be converted to cash in less than 3 business days, or 3 or less, Moderately liquid investments which are expected reasonably to be converted to cash in more than 3 business days, but less than 7. And as we get to the other end of the spectrum, the less liquid investment expected to be sold within those 7 business days, but not settled until after those 7 business days. And at the far end of the spectrum, we have illiquid investment not expected to be sold within the 7 business days. Go into liquidity management to try and manage around that LRM. So we have the highly liquid investment minimum. So this is meant to give funds latitude to decide how much of a fund's NAV will be kept in that category 1 of highly liquid. So there's not a specific percentage mandate, but once this chosen level has been created as part of the overall LRM, a fund must adhere to its written policy. If a fund decides to change this level, the policy must be updated. Note, if a fund's percentage of NAV falls below its stated minimum guideline, the level can't be changed without board approval. So essentially, you can't be changing it after the fact. If a fund is below this minimum for 7 consecutive calendar days, the fund administrator must report to the board within 1 day after the 7, and the SEC must also be notified at this point. Which brings us to our next bullet, the Form N liquid. So if that highly liquid minimum is breached for these 7 days, the mechanism by which a fund alerts the SEC is via a Form N liquid, and that would have to be submitted again within 1 day after that 7. Next category, on the other end of the spectrum, we have the category 4, the illiquid investments. For this, there's certainly more concern. There is an actual stated limit of no more than 15% of NAV that can be held by a fund in this category. So if a potential transaction will put the fund over this threshold, the fund can't proceed with that transaction. Here we see the intersection of the compliance and the trading desks. If market forces drive the fund above this threshold, the SEC must be notified via that same Form N liquid within 1 day. Internally, the fund must create a plan to get back into compliance and notify the board as to the circumstances of the breach. Portfolio managers and compliance will be working hand in hand here to manage this process. There will be much attention given to potential breaches due to the requirement of the 1-day notice of N liquid notifying the SEC. Finally, segregated assets. So this is a derivative-specific measure of the liquidity rule. So each fund must disclose what percentage of their designated highly liquid assets are being used as margin to cover for any moderately and less liquid derivative instruments. The idea here being that readily available liquid securities are not tied up. The highly liquid investment minimum must be ready for actual redemptions. So that's an overview of the recent regulatory landscape and how we have led up to the eve of Form N-Port. Regulatory oversight has been increasing every year, and it's going to continue to do so. There is a balance to achieve, looking to create performance for your clients while preparing for adversity. This preparation will certainly cut into potential gains, but will limit the downside. The global economy, meeting this balance is vital. We're seeing more compliance interaction with the trading desks as these risk and liquidity monitoring are now potentially involved in a daily regulatory requirement in the form of a breach. 2007 and 2008 showed us that overconfidence in complex markets and instruments can lead to a mirage of liquidity. The liquidity rule aspect of NPORT looks to address this, and my colleague Alan will continue here focusing on the specific challenges of managing fixed income liquidity. Thank you.
Thank you very much, Dennis. And with that, I'd like to move on to having a look at fixed income liquidity, and in particular the challenges of coming up with liquidity scores in fixed income, and a little bit to do with liquidity risk management. Just to clarify what we're discussing here, we're going to talk about market liquidity risk, which, according to the Basel Committee on Banking Supervision, is the risk that a firm cannot easily offset or eliminate a position at the market price because of inadequate market depth or market disruption. And in particular, we're going to focus on liquidity in the bond market. What we're not discussing is funding liquidity risk, which, while a related issue, is more to do with the cash flow and collateral needs of a firm to operate on a daily basis. So more specifically, first we're going to look at what we want to measure when we say we're measuring liquidity, something which in itself isn't directly observable. We're going to break the problem into three constituent parts, and then we're going to look at some of the data commonly used to build a liquidity score. After that, we'll move on to look at market impact and calibration, and then we'll take a brief look at management, not just measurement. So the first step towards liquidity risk management is being able to measure it, so that's a natural place to start. How would we like to measure liquidity? Generally in the market, there are three common ways of doing this. The first is to come up with a relative liquidity measure between assets, such as a liquidity score. This is particularly useful in portfolio construction. The second is a days to trade number for a given market impact, and that's particularly useful in terms of today's discussion because it's useful for helping you meet NPORT regulations. And the third is to switch that around and assess what market impact you would find for a given immediacy of trade. This variant is particularly useful for understanding your potential loss if faced with unexpectedly large redemptions. A natural question when we start looking at coming up with a liquidity measure is to say, well, can't we just do the same as our equity colleagues? In equities, a common measure is days to trade, which is often defined as the size of position over a certain percentage of average daily volume. We can argue over what that percentage should be, whether it should be 5, 10, 20%, something completely different, and different firms will have a different view on this. Or should it be on the primary exchange or globally? Or perhaps, as I would do, to look only at the exchanges in which you have access to. But the real killer is that a good measure of daily volume for bonds in general just doesn't exist. And this lack of data in the fixed income markets compared with equity markets is a recurring theme throughout, not just in liquidity scoring, but all over. We're going to attack the problem by splitting it into three parts. First, the creation of a relative measure of liquidity. Then we're going to move on to look at how we extend this to bonds with limited data. And thirdly, we're going to move on to the calibration of days to trade, taking account the size of the trade and the execution cost. These together will feed into liquidity risk management, and in particular, in fulfilling the regulation form NPORT. So I'd like to start by taking a look at some of the inputs which are commonly used in the market for coming up with liquidity measures. These inputs can be split into three categories broadly: security characteristics, pricing, and trading. So starting with the characteristics, you'll see here I've listed each item with an availability. Amount outstanding has very high availability. We know the amount outstanding on the majority of securities, and this is a great way to get started, and a lot of people do just this. We've also seen coupon used, again, very easy to come by, and the age, attempting to take account of the fact that newer issues tend to be more liquid than more seasoned issues. We've also seen time to maturity used, and on or off the run, although on or off the run information isn't all that relevant for the majority of issuers. It's great for looking at sovereigns or agencies perhaps, but then in reality that's not where your liquidity measurement problems tend to lie. Looking at the pricing terms, well, price itself can be used. It's often possible to get a single price for each day, but it may be an evaluated price rather than a traded one. And this can have some knock-on consequences, especially when you move on to, say, bid-ask spread, where while some vendors may supply it, but it's difficult to know how much is real and how much is matrix priced. And there's a real risk that if you start to base your liquidity score too heavily on a bid-ask spread, that all you may end up doing is reversing out the matrix pricing algorithm that your vendor has used to come up with that bid-ask spread in the first place. Volatility is a useful measure of liquidity. High availability in as much as you can always calculate it given a price or a spread time series, but I've labelled this as medium in that you can't usefully calculate it in a lot of cases. If the price hasn't moved or a spread has rolled over a period of time, and if prices are infrequent, you can get an artificial view of the volatility of that asset. We've also occasionally seen used whether a bond is trading at a premium or a discount. This one's perhaps surprising. I find it surprising. Other people I've spoken to do as well. But we have seen it used, and equally duration time spread we've seen going into liquidity measures. We then move on to the third category, which in some sense is the most interesting, as this arguably is the only real data that we have on liquidity. Trade volumes are available with some level of adequacy in the US by virtue of the trace feed. It doesn't capture everything, and it does cap volumes. We've seen this causes particular problems. For example, if you have something that's highly liquid and the volume becomes capped out, then it'll make these highly liquid securities look a little less liquid than they are in reality. But for all its shortfalls, this is what a lot of the academic literature uses as a starting point. In Europe, we have some level of price reporting, but it's fragmented and not to the same extent as in the US, but we're hoping this should improve with MiFID II. Finally, and sometimes of particular interest, are inquiry volumes. That is to say, the volume of inquiry of trades that then haven't gone on to be traded. Unfortunately, the availability of this is very low. It's not generally publicly available, and unless you happen to be attached to a bank's trading desk, you're unlikely to ever see this. Across this set, the four that we found generally to be the most useful are amount outstanding, bid-ask spread, trade volumes, and inquiry volumes. So now we've looked at liquidity scores for bonds on which we do have data, we need to extend it to bonds with limited data. Really, we have two choices here. Either extend the individual factors and then create the liquidity score, or create the liquidity score on the bonds which have data and then extend in one go. Either way, it's all about choosing sensible comparables and making good use of what you do know. The higher quality your classifications, the better position you're in. So consider classifications such as the following. Risk entities, which are the parts of an issuer structure which can be treated in the same way for risk purposes. Subordination, sometimes known as tier or seniority. Country of risk, sector, and currency. It's worth bearing in mind that Santander trading in euros has a very different liquidity profile to Santander trading in Chilean pesos, for example. To give some insight as to how important we see data within Axioma, somewhere around half of Mac research time is spent just looking at data. Now, we also said you need to get the most out of the data that you do have, and here I'd like to take Trace as an example. Trace provides daily traded volumes, but in terms of coming up with a liquidity score, they're often not much help as they're too volatile. Monthly volumes may well actually be more useful. So what if a particular dollar bond didn't trade at all, or traded once in small size? Does that mean it's illiquid? And what if other dollar bonds from the same issuer are all traded more heavily? Should we consider our example bond as liquid instead, as it would probably trade if we tried to sell it? The truth probably lies somewhere between the two, and we need to account for this. Moving on to market impact. The most commonly quoted measure in the literature is probably the Amihud's illiquidity measure, which is stated here, and is a function of return of an asset on a day and the volume of the asset traded, looked at only over the number of days in the period in which that asset did trade. I would probably want to use something like spread move times duration for return if we did this in fixed income. It is usually stated in an equity sense and detrend it. By the way, it has a nice intuitive interpretation of being the absolute return per unit volume. It does ignore the liquidity smile, but arguably that's not so critical because in terms of order of magnitude, the smile may well be within the price variation of what you get from different vendors. Having come up with market impact, we need to calibrate it, and this means we need to decide what level of market impact is considered insignificant. Recall that when Dennis was talking about the regulations, he wasn't saying about what you could trade at zero impact, it was what you could trade at an insignificant impact. The use of internal traded data could be key to an individual firm's calibration here. So, who systematically records market quotes at the time of a trade? If it's not something that's already being done, it might be worth starting. Again, having done this for bonds with data, classification of bonds with no real trade data is going to be key. Having established your groups, you need to aim to find a cost as a function of size and liquidity score, as shown in the example market impact cost surface on this screen, in which you'll observe that the highest market impact cost is unsurprisingly where the liquidity score is right down at the illiquid end at zero and volume is very high. So now we've considered how one might build a liquidity score. What really are we looking big picture in a liquidity score? Well, I think the most important thing is that it needs to make intuitive sense. If you think about what you're replacing here, it's the ability to walk up to a trader, ask them what's liquid, what's not liquid. Ideally, you want an algorithm that can replicate that, and on a daily basis. You couldn't expect a trader to update that frequently, but from an algorithm, you expect a daily calculation. You also expect stability. So you have to ask, well, how quickly should it react to market information? There's a lot of noise in the underlying data, and what we don't want is to translate that into noise in the liquidity score or days to trade numbers. If you have a position and your algorithm is telling you that you could liquidate that position in 3 days, and then on the following day it tells you it would take 8 days to liquidate, and then on the next day it tells you it would take 4 days to liquidate, that's not really much help. Somewhere you need to build in stability. How about the weightings of the various inputs we've seen? Well, we've seen all sorts of variance on this, but in particular we've seen measures which are heavily reliant on trade data. These appear to miss the fact that some bonds are closely held so never trade, but if you had to sell it, you'd certainly find a buyer. And we've also seen measures which rely heavily on bond characteristics and pricing data, but to me these appear to be measuring something without using the only real information available, which is your trade and inquiry data. How about one or two-sided liquidity? Well, I think it's a little optimistic to expect to get a separate liquidity score for the buy and for the sell side of a position, but it should be taken into account, and perhaps there needs to be some penalization where bonds are trading one-sidedly. So, for example, for some European financials which are tightly held by asset owners with a long time horizon, they might be very hard to buy, but if they wanted to sell, they'd be easy to sell. With that, I'd like to take a brief look at management, not just measurement. And here is my example. I take 3 cases of the Axioma Portfolio Optimizer. Use case 1 is where we've already established a liquidity score, this example 0 to 10, from illiquid to highly liquid. We can run an optimization under the constraint that the average liquidity score should be at least 6, say. It might not give you an idea of distribution, but in that case, that tells you the average liquidity of your portfolio. The second example is, well, suppose we know the size of each asset which can be bought in an immediate basis is the amount that you can buy or the amount you can sell immediately with insignificant market impact. Then we can optimize the portfolio under a constraint that all the trades are in that size range. The third, and possibly most relevant example in the terms of endport regulation is, suppose we know where the endport bucket boundary amounts for each individual asset sit, then we could optimize a portfolio constraining by these buckets so that you'd meet endport regulations by construction. And in this example, the bullet points at the bottom show how to optimize a portfolio such that at least 20% of the portfolio must be highly liquid, at least 50% of the portfolio must be at least moderately liquid, no more than 50% of the portfolio may be less liquid or lower, and no more than 15% of the portfolio may be illiquid. So, to conclude, we've looked at 3 ways of measuring liquidity: relative liquidity scores, market impact, and days to trade. We've broken the problem into 3 parts: the creation of liquidity scores, their extension to bonds with missing data, and the calibration of days to trade. And we've looked at some of the problems associated with each of these. We've looked at the properties of what we believe makes a good liquidity score. and we've looked at liquidity risk management, not just measurement, using the Axioma Portfolio Optimizer. And with that, I'd like to hand over to Amber for any questions and say thank you very much for listening.
Great. Thanks, Dennis and Alan. I think this is a good time to take some questions from the audience. If you haven't already, please go ahead and submit your questions using the Q&A tab on your screen. We have a couple already. This one, I believe, is for Dennis. What is the likelihood that import, or specifically the liquidity aspects, will be delayed?
Well, there's certainly been pushback from the industry as it relates to the liquidity portion of import. Certainly, we don't believe import itself will be delayed. And at this point, the liquidity classification, it's certainly posing issues to the industry, but we don't think that's going to be pushed back either. Liquidity is such a hot topic right now in the regulatory space, and everyone recognizes the need to have a grasp on this. And the first go-around is certainly not going to be perfect. And, you know, the vendors out there, people are still building their models based on somewhat opaque markets. So, I mean, there are challenges, but I don't believe that the regulators are going to back off of it.
Thank you. And I believe this next question is probably best answered by Alan. You've spoken about liquidity measures in general, but what specifically is Axioma looking to provide?
Yes. So right now, there's no consensus in the market about the best way to measure liquidity. So we're not sticking to one measure in particular. And as you'll see from our tagline, we do like to be flexible in what we offer clients. So when we're working with clients on liquidity, what we try to do is to come up with some variant, including various parts of what I've discussed, such that it meets the specific concerns that client has and solves their specific problems. So I think the best thing to do is if you have a specific use case, is to call our sales team on the number or email address which should be shown now, and discuss that, and hopefully we can come up with something that solves whatever the specific challenges that you find you have.
And another one, probably for Alan, could you speak a little bit about how you calibrate the liquidity smile for fixed income?
Yes. So as a reminder, trying to get the slide back on liquidity smile. I'm sorry, I can't find the right slide on that. In terms of calibrating it, that has to be based purely on the trade data that we have access to. There doesn't seem to be a good way of calibrating it that I found other than based simply on any trading data you have. So I'm sorry that doesn't provide any clever insight on that. It's just grunt work.
Great. Thanks, everyone. That's all the time we have for right now, I'm afraid. Thank you for joining us. We hope you enjoyed the presentation and got some insight into raising the bar on liquidity risk management. If you have any feedback on today's webinar or any recommendations for future webinars, please complete our short survey, which should flash up on your screen momentarily. And finally, if you found this interesting and want some more thought leadership like this, please visit our Risk Minds community page. Here, you'll find recordings of all of our webinars, articles, and interviews with global industry experts. Thank you very much from all of us, and goodbye.